All right, well, we're going to go ahead and get started. So, hello everyone, and welcome to All About Dividend Stocks. My name is Erica Reisman, and I'm the Director of Education here at Stock Rover. And also with me is Howard Reisman. He's the CEO and co-founder, and he's here to answer your questions after the presentation. Anytime you have a question, type it into the question box, and we'll get to it at the end. So we've made available the presentation outline of the demo that I'll be using today. I emailed this link out to everyone that had signed up as of an hour ago, and I believe I sent a chat out to everyone in the webinar with the URL, but if you didn't get it, you can download it here at this link shown at the top. The format of this webinar is that the first part of the webinar is a PowerPoint presentation that goes over some principles of dividend investing and dividend safety. And this first part of the webinar could be considered a companion to the new Fantasy Portfolio series of articles that are going up on our blog. So I'll be going over some of the material from the first blog posts, though not as in-depth, so I do encourage you to read those blog posts as well. Then I'll switch over to Stock Rover and demonstrate some of the principles I talked about, as well as show you how you can find and evaluate dividend stocks in Stock Rover. And lastly, this webinar is being recorded, and I will email everyone with the link when it's up on the website, which will probably be in the next day or two. So first, let's just get started with the PowerPoint. First, I'll just talk about dividends in general. So dividends are a portion of the company's earnings that are paid to a class of its shareholders. So they come from the firm's earnings. And traditionally, they're offered by more established companies, so not really high-growth companies. High-growth companies generally would use their earnings to reinvest in their business instead of paying them out. But once a firm is more established, it can choose to reward its investors with a dividend. And they're generally spoken about in per share or yield terms or in growth terms, as we'll see. So the dividend yield is just the dividend per share divided by the price. And so a yielder, so a stock that's kind of considered a yielder, will have a yield that's consistently above 3%. Generally, it's not a hard and fast rule, and it will grow that dividend more slowly. But you still want the dividend, even if it's a yielder, you want it to be growing a little bit, ideally above the rate of inflation, because if it's growing below the rate of inflation, then you're actually losing money in real terms. So there's really low inflation right now, so we haven't been talking a lot about it in our webinars, but that's just something to keep in mind. So usually yielders, as I said, are more established, and they don't have as much room to grow, and so they just want to reward their investors with a high dividend. And then there's also something called an accidental yielder, and that's when a stock's price has dropped, and because in the dividend yield, the price is in the denominator. If the price drops, the yield rises. And so it kind of has a superficially high yield for that stock. So just be aware that that can happen, and it just underscores the importance that it's always good to look at the yield in a historical context, and indeed all of these metrics actually in a historical context that we'll talk about. We're also going to talk about dividend growth. So the growth is just the annualized percentage rate of growth of the dividend over time. And so a stock can be considered a grower if it has the yearly dividend growth rate above 5%. Again, this is just kind of a rough guideline, but many stocks grow much more than that, as we'll see. And they're generally companies with more room to grow in the market. So in my second blog post in the Fantasy Portfolio series, I used AT&T as an example of a yielder, and then Comcast, its competitor, as a grower. And so Comcast has a smaller dividend, but it's growing it more quickly. So it was considered the grower in that example. Next, we're going to spend a lot of time talking about dividend safety. So essentially, dividends can be cut at any time if the firm feels that it can no longer sustain them at the current level. And this is very bad for several reasons. Number one is you just lose the dividend in that income stream. It's also bad because it's almost always accompanied by a precipitous drop in the share price. And then thirdly, it's bad because it means that there's just a general speculation about the health of your investment, which is also not usually a good thing because it can lead to a lot of volatility in the price. So the good thing is that dividends don't exist in a vacuum. They rely on these other parts of the firm. So you can do your best to kind of see if you can predict a dividend cut or kind of know if it's generally safe from that. So for that, we're going to look at earnings, cash, debt, and dividend history. So first I'll just talk about the earnings. In general, the earnings are just the engine of the whole company. So they're what causes them or allows the company to grow and gives investors confidence that they can continue to grow. So in general, we want to see earnings for our dividend stocks growing consistently. And ideally, we want them to be growing at or above the industry average for growth. So we don't want them to be losing market share over time. The other part of earnings is that because the dividends come out of the earnings, we want to make sure that the dividend's not eating up too much of those earnings so that there's not enough left over to actually grow the business. And for that, we're going to look at the payout ratio. So that's just the percentage that the dividends are taking out of the earnings. And again, you can look at just the payout ratio by itself. And you'll generally see the guideline is it has to be or should be below 50%, but that can depend a lot on the industry, and it also just depends on the firm itself. So we're going to be looking at that with regard to its peers and also with regard to its own historical context. We're also going to be talking about cash because cash is what actually pays those dividends. So you want to make sure that there's not a liquidity crisis. So for that, we're going to look at the cash dividend coverage ratio, which is the amount of times they could pay the dividend over with the cash. And we're also going to look at the quick ratio, which is the current assets minus the inventory over the current liabilities. So that essentially just will warn you if there's a liquidity crisis. So if it's below 1, it means that its current liabilities are above its current assets. It might have to come up with some cash quick, and part of that could be cutting the dividends. So it's a good metric to keep track of. Also, just in general, sometimes cash is a better gauge than earnings. If the business has a lot of non-cash charges that are affecting its earnings, the earnings can look so-so, but then it can have really strong cash flow. So it's always good to look at both. Debt is really important to keep track of with dividend stocks because the interest on debt has to be paid before dividends. So you really want to make sure it's staying at a manageable level and the interest payments aren't threatening the dividend. So for that, we're going to look at long-term and short-term debt. For long-term, we'll just look at debt to equity and kind of see, is it changing over time? If it's increasing, that could be a troublesome indicator because it could be more high risk. It could mean that interest payments are going to could potentially threaten the dividend in the future. And then we're also going to just look at short-term debt as well. So the interest coverage ratio is how many times the firm can pay the interest on its debt over in the cash that it has. And again, you want to make sure that it has plenty of cash to pay the interest and it's not using up all of its cash on interest payments, so it has cash left over for dividends. Lastly, we'll just be looking at the dividend history itself. So we want to see how the company has managed its dividend payments in the past. If they were able to kind of keep a steady dividend and even grow it, even in lean times, that's a really good sign that the management is able to effectively allocate its resources. So we'll just be looking at the history. And of course, past behavior isn't necessarily an indicator of future behavior, but it's a pretty good sign if it looks like the management has taken care to take care of its dividend and make sure it's not cut. So just to sum up everything we've talked about, excuse me. The stocks are generally yielders or growers, and in general with dividend safety, which is what we're mainly going to be talking about today, it's linked to general company health. So we'll take a holistic view of the dividend by looking at earnings, cash, debt, and dividend history. And also, it's it's always important to look at the metrics in comparison to the industry average and also their own historical average. So you never just want to look at a metric and not compare it to and kind of not know where it sits. So with that, I'm going to leave the PowerPoint and go over to Stock Rover, but then the demo outline is with the rest of the PowerPoint that I've sent out. So bear with me while I just move over to Chrome. All right, and I think you can all see that. So now I'm just going to show examples of a dividend grower and a dividend yielder just to kind of demonstrate what I talked about. Hang on, just want to getting a notification. Okay, I think we can all see that. Good. So first I'll just go over a dividend grower and a dividend yielder with a specific stock. And for that, I'm going to use Seagate Technology, STX, and Bank of Nova, which is BNS. So you can see that they're both here in the table. Here is research tickers, and I've also charted them below. And first I'm going to go to the fundamentals and show you the dividend per share. I'm also just going to switch it back to to 5 years because I feel like the pattern is a bit clearer there. So here you can see that the Bank of Nova is in blue, and you can see that it has a higher dividend per share, but it's not growing it as quickly. It's just kind of stepping up a little bit, whereas Seagate, which is in orange, started actually with no dividend at this time period, but then it stepped up, has great, it's increasing it faster, and it's catching up with Bank of Nova. So if you want, you can think about sometime in the future, if they continue with this trajectory, they're going to cross. In addition, you can also see that there's Seagate has had much more volatility, but ultimately much more price appreciation, which contributes to your overall total return. And Bank of Nova has kind of not as been volatile, but it hasn't had nearly the price appreciation. So that's one reason that we at Stock Rover really like dividend growers, is because a lot of times they're accompanied with this price appreciation. However, a lot of investors like yielders because they just receive more dividends, and then they can reinvest those and more rapidly grow their kind of base of their portfolio. So, but today I'll just be talking about dividend safety in general. So now I'm going to step back, and instead of looking at a specific grower and yielder, I'm just going to look at how you can look at those two categories more broadly, and I'm going to do that by charting screeners. So first I'm going to clear the chart, and then I'm going to go over to my screeners, and I have this dividend growth screener, and this is available in the library for you to download. And this is searching for stocks that have a yield between 1.5 and 3.75, and then it's been growing its dividend at least 8% over the past 5 years, as well as growing its earnings at least 8% and sales at least 4% over the past 5 years, and its payout ratio is below 40, but above 10. So first I'm just going to right-click that and select Chart. And here you can see this is how the stocks that are currently passing this dividend growth screener have done in the past 5 years. So it's important to note that it's not backtesting. We also have this yield screener, which is also available in the library. It's a little more simple. It's looking for stocks that have a yield above 3.75%, and it's been growing that dividend over 3%, and the payout ratio is below 50. Again, that's just kind of the baseline. Across all industries, you don't really want to see the payout ratio bigger than 50. And if I chart that, I can right-click, select Chart, and see that this is how the yield stocks have done in the past 5 years. So here you can see that the dividend growers have been doing better than the yielders. And we can actually see how they've done against the kind of wider market by using the S&P 500 as a proxy, by going to benchmarks and selecting the S&P 500. And you can see here that the yielders were outperforming the S&P for time, although recently it's been a bit more volatile. But in general, the growth screener has done better. So that's just how you can kind of step back and look at a wider amount of yield and growth stocks before actually looking at specific ones. But next I'm going to show you a ready-made screener that comes with Stock Rover, and then find a stock and then show you how you can evaluate its dividend safety. So for this, I'm going to clear the chart and clear the table. And I'm going to be working with this dividend growers screener that you can see I've moused over, and you can see the criteria. So this is a quant screener, which is a premium feature. It has a little star next to its icon, so that's how you can tell it's a premium feature. And if you're not familiar, what our quant screeners do is not only select stocks that pass the criteria that's listed in the first part of this tooltip, but it also ranks them according to the weight that's listed under the quant ranking. So it kind of can focus the screener results. So this is a premium screener. I believe it comes with your Stock Rover account, but if not, you can get it in the library. Basic users can still run this screener. They just won't have access to the quant part of it, so it won't rank the stocks, but you can still get all the results. So this is the one I'll be working with today. So first I'll just show you, I'll just chart the screener, and then show you that the stocks that pass have done quite well against the S&P 500 over the past 5 years. So already I feel pretty good about the stocks that are going to be returned. But just to show you again what those criteria are, it's a yield below 5%. And then it has accelerating dividend growth. You can see that the 1 year change is 7%, 3 year change is 6% and 5-year change is 5%. So that means that it's not only growing its dividend at a good rate, but it's actually accelerating that growth. And then it also has strong growth in EPS and operating income and sales. And then we're looking for stocks that are greater than 1 billion, and the payout ratio is going to be below 50 but above 10. And I'm just going to take a sip of water. Excuse me. Okay, so to run the screener, I'm just going to click it in the navigation panel, and that'll load the 50 passing stocks here. I also want to point out that all of today's webinar is going to be in this dividend safety view here, and this is a view that I've created especially for this webinar. It has all of the metrics that I'm going to be looking at. I actually often do this whenever I have a specific research task. I usually just create an entirely new view so I don't have to kind of go hunting around for the different metrics. And you can download this in the library. If you go to Library up in the top left and go to Views, it's this top one here. You can see that I added it today, so you can download it if you want, but just know that that's the view that I'm going to be working in. So here you can see that the returned stocks are ranked and they're sorted by rank. The first stock that's passed is AmTrust Financial, and if I mouse over the rank column, you can see its quant score and you can see why it came in as number 1. So the first part gives the percentile value for each of its the quant rankings. So you can see that it was 97th percentile in dividend growth, 87th percentile in 5-year average for EPS, and 85th for operating income, 94th for sales. So just really strong numbers all across the board, and that's why it came in as number 1. So now I'm going to delve into this and take a closer look at its dividend, going through those 4 dividend safety areas, which is earnings, cash, debt, and dividend history, and see how it does. There are other webinars in Stock Rover where we do a deep dive of just the company in general. That's not what I'm going to be doing today. Today I'm just going to basically be evaluating the dividend. But of course, when you're actually going to invest, you should do a holistic and comprehensive deep dive on the stock. So first, I'm just going to chart it against its industry, which is something that we almost always do in Stock Rover to start out. So I'm going to go to the benchmarks menu and select industry. And this is over the past 5 years, and I can see that it's done quite well against its industry. So that's a good sign. I'm not picking a stock that's underperforming its industry. So I can also see how the sector is doing by adding that in. And I can see that the industry is outperforming its sector. So that's also really good news, because it's in an industry that's doing well against its sector, and the stock is outperforming both of them by quite a lot. So that's not strictly related to dividends, but we just always do that in Stock Rover, or almost always when we're researching a stock. So now I'll delve into its earnings, and I'll just remove its benchmarks here. So the first thing we're going to look at is the earnings per share to make sure that they're increasing over time. So there's a couple ways you can do that. I've added the earnings per share in this dividend safety view, and I can expand the table row by clicking this arrow to the left of the ticker symbol, and that'll give me the historical data here. This is yearly, but I could switch to quarterly, and overall I can see that it's been increasing. However, I generally like to use the chart instead of the table because I just find it easier to digest. So what I'm going to do is go down to the fundamentals and go to EPS, and I've also changed the favorites here, so it's all of the metrics I'll be using today, and I did that through the modify button there. So I'm just going to select earnings per share and see that over the past 5 years it's been increasing its earnings, and particularly in the past couple years it looks like it's accelerated that growth. So that's a really good sign in general. So it gets a check mark for historical EPS. I can also see how this earnings growth compares to its industry. So we know that the stock itself is outperforming its industry, but we want to see how the earnings are as well, because they're not necessarily linked. So for that, I'm going to go over to the summary tab. And if you're not familiar with the bottom sections here, I highly recommend you check them out. I use them all the time. Basically, it shows some key metrics in performance, valuation, profitability, and growth for the selected stock. So we're at AmTrust Financial. And then it shows the values for the stock and the industry and the S&P 500. So you can really easily see how it's doing. So I'm going to look at the EPS 1-year change, and it looks like even though it grew at 49.5% over the past year, which is quite high. It wasn't quite as high as its industry, but those are both such strong growth that I'm not troubled by that. Likely by the, or similarly with the 3-year growth rate, it's quite high, not quite as high as its industry, but again, not really showing cause for concern. And then also the 5-year average was above its industry. So none of this is really flashing red, so I can kind of give it a check mark in the earnings department. The second part of earnings that we are going to look at is the payout ratio. So again, not just how the earnings are doing, but how much are the dividends taking out of those earnings. So you can, again, look in the table and see that it's at 12.7%. Now that is well below the kind of guideline of 50%, but again, you never just want to look at these metrics once right now and then just, and not look at them again. You want to know, you kind of want to understand their context. So for that, you can also expand the table again by clicking that little arrow here, and I can see that it looks like the payout ratio has been fairly steady over time. Or I could also just throw that in the chart by going to the fundamentals and selecting payout ratio here. And you can see it kind of goes up and down, but it's still, it's not going too high. It's only at 17, almost 18 at the top. And if I go back to 10 years, I can see actually that although it was really high, in 2008, which we can all guess what that's from, in general, it's been pretty steady. So as long as it's not increasing, really, is what you're looking for. Because if it's increasing, that means that slowly the dividend payments are taking up more and more of the earnings, which is a pretty bad sign. So we can also see how the payout ratio compares to its peer stocks, and there's 2 main ways of doing that. The first is going to the actual peers tab on the right. So this is in the inside panel. And if you're not familiar with the peers tab, it's really a really powerful, great feature in Stock Rover. It's basically like a second table, but it only shows the stocks in the industry of the selected stock. And then you can adjust all of these columns however you want. So I've just added the ones that I'll be using today, but you can sort and filter by them as well. So we can see AmTrust Financial is highlighted in blue all the way down at the bottom here. And if you go to the payout ratio column header, and you can just click that to sort by payout ratio. And then if you go down, you can see that if you scroll down, it looks like it's not, it's pretty much towards the bottom. So it doesn't look like it has a higher than average payout ratio. So that's a good sign. We can also find the payout ratio for the industry as a whole, as opposed to seeing the individual payout ratios, by going to the sectors and clicking on financial services. And so when you click on a sector as a whole, it loads the industries as rows themselves. And then I can go down to insurance, property, and casualty and see that the average payout ratio for the whole industry is 27%. So again, we were at 12.7 for AmTrust, so it's well below. So the payout ratio looks steady, so that's good, and it's not more than its industry as a whole. So that's good. So overall, it just kind of gets check marks across the board in the earnings category. Next, we're going to talk about cash. And I'm going to go back to the screener results by just clicking back. And then first, we're going to look at the cash dividend coverage ratio. And this is a custom metric in Stock Rover. So if you're a premium user, you can go to the library and go to custom metrics here. And you can see it's just this top one here, the cash dividend coverage ratio. So you can import that into your account. And here you can see it's in the table right here. It's 15.6. So that means, again, if you're not sure what it is, you can always right-click the column header and select Explain. That brings up the column info box, which is a really useful feature. And so this is just the ratio of cash flow to dividends, shows how well a company's cash can pay for dividends. A value above 2 or 3 is generally considered safe, whereas a value below 1.2 is a warning flag. So you can see that here we're at 15.6, so it's well above the sort of safe value. But just for completeness sake, I'll just go through and show you how you would evaluate it over time and also against its peers. So pretty similar. Again, we can chart this by going to Fundamentals and selecting Cash Dividend Ratio from the drop-down menu. And here you can see that it's pretty consistent, and it's pretty high. So if it were kind of rapidly falling, that could be worrisome, but looks like it's fairly steady over time, especially in the past couple of years. I can also go to the Peers tab and then sort by the cash dividend coverage ratio by clicking the column header and see where it sits, and you can see it's almost at the top, so it has plenty of cash on hand compared to its peer stocks. Or I could also just click that financial services sector and go back down to insurance, property, and casualty and see that the average for its industry is 4.3. So it has ample cash on hand, so it's not. I'm not worried that they're not going to be able to pay their dividend for lack of cash. And I'll just go back to the screener results. And there's also the quick ratio. So this actually doesn't have a value for the quick ratio, but just know that you could do the same thing and evaluate it here. So both earnings and cash look good. So now we're going to look at debt. And again, kind of run the same program. The first thing we're going to look at is debt to equity. So right next to that is the metric in the table. It's at 0.5, but again, that doesn't really mean anything. It's just a number. You want to see how it, especially with debt, how it's doing over time. And it's not as important to compare against its peers, in my opinion. I think you really want to see just how is this company doing over time. So to do that, I'm going to again go down to the fundamentals menu, and I'm going to select debt to equity. And here you can see the debt to equity over the past 10 years. So it used to be kind of high, but you can see it looks like the management is really making it a priority to reduce that debt and bring it down. And even though it bumped up recently, they've immediately been chipping away at it. So that's a really heartening sign. It would be bad if you saw the debt kind of creeping up over time, because that means that the interest payments would get more and more and it could threaten the dividend. But this is a pretty good sign here. We can also look at the interest coverage ratio, so that's more the short-term debt. How much cash do they have on hand to actually cover their interest payments? And so you don't want that getting too low because they still need cash left over to pay the dividend after the interest. So again, I'll go to fundamentals and select the interest coverage. And with that, you can see it's kind of goes up and down, but it's fairly steady. And if you go up to the table, you can see it's at 11.3, so it can pay its interest many times over, and so it's not that you're not going to have to run out of cash for the interest payments before you can pay the dividends. So overall, the debt for this company looks pretty good. So finally, now we're going to look at the dividend history for this specific stock, and for that, I'm going to go down and just chart the dividend per share. When I do that, I can see that the dividend has been increasing over time, which is good, and it's actually been accelerating its increase, which is even better. And one thing that's really nice to see is that there's no interruptions in this dividend, so it didn't, there aren't gaps in this dividend per share. It's been consistently paying a dividend for 10 years, and there's also no revisions downward. So even if a stock doesn't cut its dividend entirely, it can lower them, which isn't great, but this company has really made an effort to increase the dividend, even in those kind of tough years over in 2008, so 2009. So this is pretty heartening. It means that the management seems to be allocating its resources effectively so it can continue to pay those dividends. So that's pretty good. I also just wanted to show the yield as well. If I go to dividend yield, you can see that the yield has gone up a little bit, but in general, it's kind of with volatility staying there, but the share price has increased dramatically. And because the yield depends on share price and dividend growth, it also means that the dividends are growing dramatically. So that's another way you can kind of tell if it's growing its dividends or not, is look at the share price and look at the yield and see how they relate to each other. So overall, I would say that the dividend for the stock looks pretty safe. But again, you would want to do some more digging and reading the filings just to make sure that all is as it appears. Next, I'm going to show just a quick example of a stock that doesn't look as good with regards to dividend safety. And we don't even have to travel very far to find it. It's just the number 2 stock here, NLink Midstream. You can see it's number 2 in the table. And if I mouse over its quant score, you can see that it has really high marks also across the board. It had a score of 86.6 out of 100, whereas AmTrust had 90.25. So it seems like it would be, a fairly good bet. But if I just click on it to chart it below, I can already see that it discontinued its dividend down here. You can see at the bottom of the chart, it's missing a big old chunk of the dividend yield. And so that tells me that the company discontinued dividends for a period. So that's already a bit troubling, kind of a warning sign. It also, you can see this is kind of one of those accidental yielding situations. Of course, these events around 2008, 2009 were kind of extraordinary, but you can see what happens when the price plummets as the yield skyrockets. And it's kind of actually thrown off the scale of even the rest of the dividend yield chart down there. But just to kind of go over a couple other parts of this dividend safety just to show what it looks like. We can also look at the dividend per share, again, switch back to that through the fundamentals menu. And you can see that they had kind of been aggressively increasing it, but then they had revised it downwards several times until ultimately cut it to zero. But they have been, rebuilding it. But again, just the fact that they weren't able to maintain the dividend in this tough period makes me a little skeptical of their ability to do it again for when the economy inevitably goes south again. So we can also look at how it did against its industry. So the benchmarks and select industry. And here you can see that overall it underperformed in the past 10 years. If I switch back to 5 years, you can see that it had outperformed, but there's some serious swings and volatility here, and it kind of looks like it's cresting and overall, so that it just looks like a kind of uneven stock. And so I think that it doesn't look like the dividend would be too secure based on the sort of swings it's going through right there. You can also look at their earnings per share. Again, if I go to the summary tab and go down to the bottom, you can see that the earnings per share growth rate is just kind of all over the place. It's vastly outperformed the industry in the past year, but underperformed over 3 years, outperformed over 5 years. It's just kind of up and down. And so again, that doesn't really get a check mark for the earnings per share. You can also look at the payout ratio. So if I go to fundamentals, select the payout ratio. This is really interesting because you can see that there's a bunch of gaps, and that's usually because the earnings were negative, which is also not good. So if you go to events, you can actually see that by adding in the earnings event here. And so this means that anytime the firm posted earnings, will come up as squares. And then if you mouse over those squares, you can see what it was. So here you can see they actually didn't show any earnings for this period, and that's why the payout ratio is not showing. So again, all of this is kind of making me feel like this wouldn't be a very safe dividend. And it's important to note that it came out really high even with this dividend grower screener, but it just, I think, underscores the importance of really digging in and not just going by what the screeners tell you. So what I could do is just right-click and color code the stock red just so I don't accidentally think that I want to pursue it any further. So that's kind of it for evaluating the dividend safety. I just want to also point out where you can find the SEC filings. It's here in the summary tab on the right. And you can see that there's annual and quarterly reports under the filings, and that'll just bring you straight to Edgar where you can read, and that's the best place to find the comprehensive account of earnings and dividends and how they're planning on paying all of it. So now my last example is just going to show how you can modify some of the existing screeners to tailor to your own liking. So I'm going to go over to just clean up the navigation panel for a second, and I'm going to copy the dividend grower screener. So I kind of like the screener as it is, but I want to tinker with it. So instead of just working on this copy and then losing the original settings, I'm just going to right-click it and select copy. And I like doing this because then I can kind of fiddle around and not worry about having to undo those changes later. So I'm just going to copy it and call it Dividend Growers 2. And then I'm going to right-click it and select Modify. And this will bring up the screener manager. And I'm just going to drag it a bit bigger as well so I can see more of the criteria here. And for this, I can see that all of the criteria are in step 3, and then I can add criteria in step 2. Also for now, I'm going to uncheck the Use Advanced Quant Features at the top in step 1. And when I do that, you can actually see how many stocks are passing. So the Quant Features limits it to just the top 50 stocks, so that's why at the bottom, it's underneath step 3, it says return the 50 best ranked. But if you undo those quant weights, you can actually see how many are passing. So it's just a bit better gauge to see if fiddling with it is actually knocking out any of these stocks or not. And then you can just click the the checkbox to get those weights back, as long as you're in the same session of the window. So for here, it's already a premium quant screener, but I'm also going to add some equations to it as well. And equation screeners are really good for kind of comparing a stock against itself. So especially with things like dividends, where values can kind of change depending on the industry, as we saw, like the payout ratio can vary by industry. You can just screen kind of against its own historical data. So to create an equation screener, we'll use freeform equation, and then here we can just type in, we can either select a metric or just type in what we want to show. So for this, I actually got a special request to show how you can screen for stocks that have increased their dividend year over year. So we do have the dividend 1 year change is greater than 7%, so we already know that all the stocks that pass are going to have increased their dividend in the past year, and also we have 3 and 5 years. So these three criteria right here kind of guarantee that it's probably not decreased its dividend, but if you did want to make sure that it didn't decrease it between 2 and 3 years ago, I could just type in dividend and then go down to dividend per share, and then this is the historical data part of it. I'm going to click that box there and select, instead of a historical data now, I want to make sure that the dividend a year ago was greater than, and then type in dividend again, was greater than the dividend per share 2 years ago. And then I can also do another equation for, 2 years ago, greater than 3 and whatnot, but I'm just going to demonstrate this. And then click Save. And this ended up not knocking out any stocks, but again, it's these three kind of ensure that the stocks that pass have probably increased their dividend every year. To do another equation, you can also make sure the payout ratio hasn't increased over the current year. So I could just type in another equation, type in the payout ratio. I want to make sure the payout ratio now is less than or equal to the payout ratio from a year ago. So that makes sure that it hasn't crept up in the past year. And then when I click Save, you can see that actually did knock out 37 stocks, because it went from 87 that passed down to just 50. So then I can just click Update and see, I forgot to click the quant weights, but again, these are just the 50 stocks that passed that new screener. So I encourage you to kind of copy these screeners or just fiddle with them yourself and kind of tailor them to the kind of stocks that you want to be finding. So that's all I have for the demo. I hope you found it informative, and I do also recommend that you read the Fantasy Portfolio blog posts if you find this interesting. I'm going to have a whole big post about dividend safety that should go up today or tomorrow, and it goes more in depth about a lot of the things I talked about, and also shows how you can find that stuff in Stock Rover that I just demonstrated. But for now, I think we're going to flip it over to the question and answer. So if you have any questions about anything that I went over today, type it into the box, and we'll start going through those chronologically. So let's see. So I think we have just, okay, yeah, there we go. So the first question is just a comment saying fancy color. I don't know if that's referring to the mouse, which is red, but hopefully you could all see it. So for the second question is, what kind of cash? Free cash flow? And Howard, you can take that one if you want.
Hello, everybody. I'm Howard Reisman, CEO of Stock Rover. First of all, Erica, really nice job in the presentation. Before we get to the questions, you might just want to show people on the website where the blog posts are.
So, oh, okay. Yes, so I will.
And then we'll go through the questions.
Yep, so just if you go to the homepage and then go to blog, and you can see there'll be preface with this fantasy portfolio. So the first one was the introduction. Now we have the dividend growth versus dividend yield, and I go more into that in the blog post than I did in the webinar, and then we'll have one posted very soon that's all about dividend safety and is fairly comprehensive. So.
Okay, great. So let's jump back to the question. So the first one is, what kind of cash, free cash flow? Well, I mean, when you're looking at dividend safety, you really want to be looking to do comprehensive analysis, you want to be looking at the earnings, the net relative to the dividend payouts, and you want to be looking at free cash flow relative to the payouts, and you want to be looking at cash flow. All three of those things matter. Free cash flow would be really critical for a company like Intel because they invest heavily in infrastructure in the semiconductor plant. So the free cash flow would basically add in the depreciation and amortization, and then subtract out the cost of the new capital, the capital expenditures, so you can kind of see how much cash they have. Now that can tend to be lumpy because cash. Capital expenditures can be lumpy, but fundamentally you're going to really want to look at all three things to make sure you have a margin of safety, which is earnings, cash flow, and free cash flow. And I think for your presentation, Erica, you looked at cash flow, not free cash flow.
Right.
Yep.
All right, the next question, does the payout ratio consider preferred shares dividends or just common share dividends? Important because preferred share dividends are paid first.
Yeah, that's a great question, and right, preferred in kind of the hierarchy of who gets paid, preferred shares are paid before common shareholders are kind of last on the list of hierarchy. So the way the formula works is it looks at the net income after preferred shares are subtracted out. So it's basically the net income available to common stockholders. So if a company is paying a large amount of preferred shares, preferred dividends, the payout ratio, you'll be looking at kind of what's available to the common stockholders. So the ratio is true. You don't have to worry about being second in line for the dividends when you use the payout ratio.
All right, the next question is, what about REITs, et cetera, that are required to pay out 90%?
Yeah, REITs and also MLP, Master Limited Partnerships, are really different animals. They are really designed to pay pretty much all their, in the case of REITs, their funds from operations or their adjusted funds from operations out, or a high percentage of that. And in the case of MLPs, the distributable cash flow, which tends to greatly exceed their earnings because of their incredible amounts of depreciation. So on both those entities, they really need to be analyzed, first of all, in their own universe against each other. And you've got to really be looking at, you got to be looking at the financial statements differently for those guys. They're just different. In the case of REITs, you're going to want to see if they're growing, if how much of their capital they're retaining, if they're retaining enough capital to grow a bit, whether they're paying out more in their dividends than exceeds their kind of adjusted funds from operations. So you still want a margin of safety with REITs, but it's obviously much thinner because they're pretty much paying you most everything they earn.
All right, the next question is, where is the dividend safety tab located?
Yeah, that one is yours. You created a tab, basically.
Yes, right? I created this for this webinar, but then I put it in the library. So if you click on the library in the top left and then go to views, it's this top one here, and then you can just select it to import it into your account if you want to use it. There is a question, they don't see the dividend grower in the library nor the dividend safety view. So I think that the dividend grower, so the dividend grower screener is, I think we have a slight issue with the defaults tab right now.
Yeah, right. We have the library's in flux. We're going to be, because we're going to be changing the design of the library, and there's a little bug in the defaults now. That would normally be in the defaults, but you're going to see that should be posted up into the library in the next couple of days. We apologize for that. The library's going to change a bit.
Yeah. Next is, what is your definition of payout ratio? Is it relative to free cash flow or earnings?
Oh, it's relative to earnings.
Yeah, and if you can also just always right-click the column header and select Explain, and that'll tell you, more exactly how it's calculated. Let's see. So someone just updated that the dividend safety view showed up after logging in and out. So if you don't see the dividend safety view, you may have to just refresh your browser, and it could show up. There was one question.
And we'll just post up the dividend growers screen to the library as well, so people can get it.
Yeah. There was a question just about why there was no quick ratio for AmTrust.
Yeah, well, quick ratio is another thing you can look at. That's basically looking at kind of the short-term ability to pay. It's the cash plus kind of cash equivalents, which is like marketable securities plus accounts receivable, and that's divided over current liabilities. And that ratio should really be north of 1 to indicate that their current obligations don't exceed their current cash, and that's another check you'd want to do for dividends for sure.
Yeah, and we can look into why it wasn't showing up, and we can email you afterwards. The next question is, AmTrust has been a very controversial company with a large short interest. How do we discover this without leaving Stock Rover?
Very easily, if AmTrust is selected in the table,
yeah.
Let's do that. And then if we go over to the summary tab, and if you want to scroll that up a little, you'll see that short is a percentage of float. And in the case of AFSI, it's 18.7%, which is huge. Mm-hmm. So there's obviously a lot of people that are betting that, a lot of shorts that are betting that there's some issues with this company that people don't understand. So that would be a sign of concern. You'd really want to research why the shorts are all over this one.
Right. The next question, relative to ENLC as an example, MLPs are valued on unique metrics that are different from C-Corps as they don't really retain earnings but manage their distributable cash flow. Are there any unique screens for MLPs? For example,
yeah, go ahead. Sorry. Go ahead.
Oh, just the last part of it. So, for example, I wonder how Magellan Midstream would screen relative to other C-Corps.
Yeah, that's a really good point. I mean, as I mentioned earlier, REITs and MLPs are both their own animals, and the only way you can really look at MLPs is against other MLPs. You cannot compare them to C-Corp. So I think the way to invest in MLPs is in general you have to decide if you want to invest in it, what percentage of allocation in your portfolio you want to give them, and then you have to decide, given that, you have to compare them against each other to see which ones you like best. I view them as a separate asset class and would not compare them to Cs. And then, based on that, you really got to look at the financial statements a bit differently because the distributable cash flow is really where it's at, and the growth of that is really where it's at for MLPs.
The next question is, you have dividend growers and dividend growth screener. Why two, and how do they compare? Yeah, well, one of them is a quant. That's the dividend growers. It has that little star, and you can see that it's it's ranking based on dividend year. But then you just have to look at the specific values. I think where's the dividend growth? The dividend growth, it looks like, has slightly higher requirements for dividend yield. They're just kind of different. One's a basic screener, one's a quant. There's different launching off points, but you should evaluate them each to see if you like one better than the other. So do stock dividends ever factor into your equations?
I'm not sure exactly what that means. I mean, I think that the equations you created, is that what you...
I'm not sure. If you can maybe email us separately or clarify your question and we can get back to it, but we'll just move on to the next one. I have too many screeners. Am I able to, 1, sort them by name, and 2, create a subfolder for one particular type of screener?
The quick answer is yes and no. So basically, to take the second part first, we have subfolder capabilities on portfolios. We've been debating whether to put them on watch lists or screeners. It creates power, but it also creates complexity, and as of this point, we've decided not to. But the best way to organize screeners, and I have a lot myself, and the way I do it is I just use the drag and drop capability of Stock Rover, and I just move them in the order I want. So if you want a dividend growers next to dividend growers 2, you just drag it up. So I drag everything in the order I want. So there's no way to alphabetize it automatically, but you could just drag them in alphabetical order if you want to see them that way, or you could group them by type. So there's different ways you can do it, but you would have to do it via manual dragging and dropping.
All right, the next question, can Stock Rover calculate a compounded annual growth rate for dividend growth?
Yeah, I think if we go to the dividend screen, dividend view, there should be a view there. Yep. It should be the 1 year, 3 year, and 5 year compounded growth there, basically. Hopefully that's...
let's actually do it.
Yeah, look at the 5 year, for example.
Yeah, so these are the compounded.
Yeah, so there's 3 built-in stats for the 1 year, 3 year, and 5 year compounded average growth. So you can see how that's changing over the period. So if you're really looking for long history, you really want to focus on the 5 year.
All right, the next question, do you have a quant screen that ranks finalists across these core factors?
Do you?
We don't. That is something I could work on developing, though. That's a good suggestion. The next is, can you track FFO and AFFO of REITs, Stock Rover, plus distributable CF of MLPs?
Yeah, distributable cash flow MLPs, that's a really good question. And the short answer is no, we don't have explicit metrics to do that. It is on our list to do that. They can be calculated from the other financial statement metrics, but you would have to basically create your own, you'd have to submit a request for custom metric if you're a premium user. We just at this point haven't done that, but it's something we do want to do, and it's kind of on the metric to-do list for us this year.
All right. The next question was about a specific ticker, Chevron, I think. He said, how reliable is this dividend yield data? I cannot see the yield above 4.2% in recent weeks, although it's spent considerable time in that region. What is the reason?
Well, you'd have to stick it into the chart and see what it looks like.
Yeah, and I can just also take it lower. Yeah, I don't know. I guess we can, if you email...
What's the peak there? What's the highest number there?
Yeah, it looks like it's about 4.1. So I'm not quite sure. We can look into that after the webinar to see, to make sure that data feed is coming in accurately. Next question, in the summary table, you show the ex-dividend date, but not the payment date. Why? Both are announced simultaneously by a company.
That's a good question. We just basically, when we did dividends, we didn't have any of the dates, and originally with Stock Rover, and the community kept asking us for ex-dividend date. We put it in. The payment date request was not asked by as many people, so I think we just it was an oversight. But it's something that actually is on the metric to-do list along with the REIT and MLP metrics, and I think it's something you'll see in the product over the course of the year.
All right, the next question, is there a screen for companies which increased dividends in 25 years in a row without adding 24 separate conditions?
No, because first of all, we only go back 10 years, so the best you could do is look at the last 10 years. We could add a dividend 10-year average stat metric, and maybe that's something we should do if people want a longer history, but you're right, without adding that, you'd have to add 9 conditions, which I don't think anybody really wants to do, so we will look at adding a 10-year metric to it for dividends.
Okay, so the next question, I have somehow changed the way the screener displays. Above the tabs is display the criteria. Can I change this view? And I'll take this because I can demonstrate what he's talking about. So you can run a screener just by clicking on it, but you can also screen a table. So say if you have like a portfolio or something listed by right-clicking and going screen current table from the drop-down menu. And when you do that, it'll add those criteria up at the top, and those criteria will stay there until you remove them. So it's important to know how to remove them, which is to go to the filter, clear filters, and select all. So and then that should clear them away. So that's something that I chose not to go over with this webinar, but you can also, in addition to just running screeners, you can also apply them to a set of tickers. But you want to look for that filter and then clear filter option. This is an off-topic question. Why can't I search for a ticker symbol for a security using multiple words?
Yeah, we've heard this one before, and it's something we've looked at. The way it's been kind of a debate internally about that as well. There's been some complexity in doing it properly is the short answer, because space is actually used to indicate you're done with that ticker and you're on to the next ticker. So we'd have to determine when somebody really wants to put a multiple word single ticker in versus when they put one thing in and select it and are on to the next one. So it's kind of on our active debate, future feature thing. I think it's something we would like to address, but it is not addressed right now. It is an issue.
All right, the next is kind of more of a comment. You guys run a first-class operation. You seem more like my stock screener consultant than a stock screener software product seller. Keep on.
Well, thank you. I mean, one of the things we try to do with the investment community is provide really a great tool and the knowledge on how to use it to help, investors make better decisions themselves. That's really what we're about. We're not about hawking anything. So hopefully the tool is helping people find investments that will help them meet their objectives.
All right. And then just another comment about WRT and CVX price and div yield graphs look like a mirror image. Yeah, I'm not quite sure, but
yeah, well, that's typical. If Chevron's not growing their dividend very much, and I haven't really checked to see if they are or not, as the price goes down, the yield's going to go up, and vice versa. So you would expect that to happen. And given what's been happening in energy, clearly it's probably been difficult for Chevron to grow their dividend. So effectively what you're seeing in the one-year period is the mathematical relationship that as price goes down, dividend yield goes up and vice versa. So that is why they're mirrors. The only thing that would distort that is if Chevron was dramatically increasing their dividend in that period, that would make them not quite mirror images, but in this case, it is pretty much the case.
Okay, and the last question that we have is, you have mentioned this, what universe of stocks was your screeners based on?
Yes, it's based on the North American kind of population of stocks, which is around 8,000 tickers, and it excludes really small cap companies that infrequently trade, that have minimal trading volume. So it's 8,000 companies with significant trading volume, reasonable trading volume above small cap and above, that trade on the NASDAQ, the NYSE, and the Canadian, the Toronto Exchange, basically TSX. So that's the universe we pull from.
Okay, great. And that's all the questions we have now. So if you do think of something, you can just email us directly and we'll try to get back to you. But I hope you found the webinar enjoyable, and thank you for staying till the end. And I also encourage you to read those dividend blog posts that we're posting with the fantasy portfolio, because it does go more in depth into a lot of what I talked about. So thanks very much, and I hope everyone has a great day.